Asian stocks eased in cautious trading ahead of a U.S. inflation reading this week that could influence the timing of the Federal Reserve's easing cycle. Investor focus is squarely on the personal consumption expenditures price index for January, which is the Fed's preferred inflation measure. Meanwhile, fashion retailer Woolworths reported a 7.5% fall in half-year earnings as consumers pulled back on discretionary spending. Woolworths said an increasingly challenging macroeconomic backdrop, given the sustained effect of interest rate increases and higher living costs, impacted its results. To give us more perspective on this, we are joined by Thato Mashego, who's a portfolio manager at Sanlam Private Wealth. Thato, thank you so much for your time. Let's have a sense of what's driving markets right now as you look at your screen.
Well, good afternoon, Nastasia. I think markets are in a bit of a wait-and-see moment. You mentioned some of the data that we can expect later in the week from the US, in particular with inflation and GDP figures. Obviously, that is going to play an undercurrent in terms of markets' expectation for rate cuts. Obviously, if GDP growth is strong and inflation remains sticky, then people have to sort of pare back how many rate cuts they anticipate from the Fed this year. So that's one of the major driving forces of markets. Some smaller news, one could mention Apple announcing them shutting their autonomous vehicle unit, and over in Hong Kong, Country Garden being brought to liquidation by some of their bondholders. So some micro news which has an impact on both the Chinese and the US markets as well.
Woolworths released its interim results. Looking at the share price now, it's down 5%. What was the key takeaway for you when you look at those figures?
Well, I think the Woolworths results could be described as the good, the bad, and the ugly. The good being Woolies Food, the bad being Woolworths Clothing, Home and Beauty in South Africa, and the ugly being Country Road in Australia. I mean, you mentioned as a whole, HEPS was down 7.5% for the group. But if we just look at it from a divisional perspective, we had EBIT growth of around 13% for Woolies Food in South Africa. We had negative EBIT growth for Woolies Clothing of around negative 5%. And in Australia, we had very disappointing negative 46% operating profit growth for Country Road. Some of the macro themes underlying that, obviously, we know that consumers are under pressure, both in South Africa and Australia, higher use of credit. We saw increasing impairments in the financial services book, so around 6.5% impairments on that book at the moment. And locally, we know that load shedding is still impacting on footfall. And the port congestion, of course, impacts on the supply chain. So there's higher stock levels that leads to working capital drains. So all of that's kind of negative. I mean, one of the positive aspects is the growth in online. So Woolies Dash is doing quite well in South Africa. Now 5% of sales in both the food and the clothing side of things. Country Road, a lot higher penetration from online sales at about a quarter of overall revenues, but one questions obviously what that means for margin outlook going forward. And given the very negative same-store sales of negative 10% in Australia, they mentioned they're still increasing on their footprint there. So one might question what the margin outlook is. But overall, I think we can see some fairly good indicator of moat in the SA business, where price inflation did not lead to a collapse in volumes, and margins are still maintained on the food side, whereas on the clothing side, we did see a decline in margins and thus negative earnings growth. So a bit of good, bad, and ugly. And the outlook, unfortunately, may not be great in the short term, but we definitely hope to see recoveries in both the SA and Australian economies going forward.
Someone whose outlook was not good was the Cashbuild CEO in our earlier conversation. What do you make of the DIY home improvement sector in South Africa? Was there any part where it was attractive to investors?
Well, I think if we look back historically, there definitely was a secular boom in DIY home building, definitely if we go back 10 years or so ago. And that was in line with increasing activity on the construction side of things and on the property side of things. And so we saw an increased need for, I suppose, home builders, traders, and other segments of Cashbuild's customers. But we know currently there's been a market decline in the construction activity in South Africa, and that impacts directly on Cashbuild's customers, and hence, I suppose, the relatively weak results that we did see. I mean, they mentioned that, their stock days are now sitting at 90 days, and inventory overall increased 10% year on year. So that tells you that there's definitely very limited demand at the moment for the sector. So the outlook can't really be said to be positive. And them impairing some of their assets also just speaks to their own view on the outlook going forward. So unfortunately, not really a pretty picture, but one needs more of an improvement in general, infrastructure, property sector, and just demand for housing for us to see an improvement in that particular space.
Before I let you go, as we wrap up, a lot of companies are going to be releasing results in SA. What's the one thing you're going to be paying attention to?
Well, there's quite a few things, I guess, that we could pay attention to. Maybe one thing would perhaps be margins. We obviously know that inflation over the past year has been quite elevated. So how have companies managed their margins? Have they tried to pass on those price increases to their customers? Have they held back and taken a bit of hit on margin in favor of maintaining volumes?
Yeah.
And what that means for the bottom line. So we'll have a look at that.
All right, Thato, thank you so much for your time. That is Thato Mashego, who is a portfolio manager at Sanlam Private Wealth.